Now, it's good to extend credit to our customers because that facilitates transactions, it makes it easier to sell to our customers, and just in general in the business-to-business climate, a lot of times it makes sense to extend credit so that the customers can pay on a kind of a routine basis. The risk is that we don't get paid. And obviously, at the end of the day, just like in the movie Jerry Maguire, show me the money. We need to get paid from our customers so that we have that cash for all of our operating needs. So one of the things we have to do is we have to take a look at what is the net realizable value of our accounts receivable. I've got a list of accounts receivable right here. Just a short list of customers to illustrate things. You can see the total receivables balance is $200,000. So what that means is at this point in time, our customers owe us $200,000. That would be a current asset on the balance sheet. Current because we expect to convert that into cash within the next year or the operating cycle. Now, of course, we would like to collect that much sooner than a year. And this accounts receivable trial balance goes a step further to look at what we would call an aging. So we've got accounts that are 0 to 30 days past due or 0 to 30 days old, 30 to 60, 60 to 90, over 90. There's nothing magic or prescribed or special about those categories. Companies can use whichever categories are meaningful for them. I just made it easy with every 30 days kind of thing here. So what we have to ask ourselves is, even though the customers owe us $200,000, how much of that can we really expect to collect? So we realize that we may not collect that full $200,000. This is where the allowance for uncollectible accounts comes into play. We will still, on the balance sheet, record the accounts receivable at its total amount, because keep in mind that financial statements are supposed to give users information about future cash flows. How much, how likely, and when will that cash arrive, or when is it likely to arrive? So we want to let people know that the gross accounts receivable is $200,000, but then we want to, there's a principle we've talked about, the principle of conservatism, okay? And it has nothing to do with how you're going to vote in an election. What it has to do is basically saying, if there is a likely chance that what we will collect in this example might be lower than the full amount, then let's present it at the lower amount to be conservative in our presentation. You could almost think about it as under-promising and hopefully over-delivering, because even though these accounts receivable are being recorded at $190,000 on the balance sheet, that is the net asset. We'd be tickled pink if we collected all $200,000. Now, we're just being conservative in the presentation. What we're also doing, and this will be clearer in a few minutes, we're also upholding the matching principle by matching bad debt expense with the revenue that is related to that bad debt expense. So one way of coming up with this allowance is to simply maybe take an estimate like, okay, $200,000 of accounts receivable, and maybe we think, and this is just management estimating, maybe we think that 5% of those accounts receivable would be uncollectible. So what we do is we simply make the allowance. That would be using the entire accounts receivable balance. But we might want to get a little bit more specific and granular in our calculations. So let's take a look at what we could do with these aging columns. So what we could do here is take a look at each one of these individual columns. Because the reality, and I'm sure this makes sense to you, is that as a receivable gets older, the likelihood that we will collect it becomes much lower, okay, as time goes by. So we might say, just as an example, and there's nothing magical about these percentages. These are going to be the estimates made by the company's management, okay? And these are estimates. Financial accounting is full of estimates. So maybe they say, you know what, we think that 1% of the most current receivables have a chance of not being collected. So that translates to $1,300 in this case. And we think that 4% of receivables in this category wouldn't be collected. All right, so that's $1,400. 10% of receivables in the 60 to 90 day category. The math is pretty easy here because in my example, I didn't have any receivables in that category. And then, you know what's happening is 40% of these receivables, we think that there's a pretty, there's a pretty good risk we may not collect some of that money. So what we can basically do, the math is not difficult here. You basically multiply each category by the relative percentage and then add up these amounts. That's $16,700. So what we're seeing here is that's where we're coming up with this estimate. There's more than one way to come up with these estimates. This is just an example. Okay, so what we need to do is we need to adjust this allowance. Now, just hang with me. Pretend that before any adjustment, the accounts receivable had a balance of $200,000. And the allowance, you might remember this from earlier in our discussion. Let's say the allowance has a current unadjusted balance. In fact, let me just label this so that we're all clear. So the unadjusted accounts receivable allowance is $10,000, a $10,000 reduction of accounts receivable. So that gives us a net realizable value of $190,000. So what's going to have to happen if we determine, like we did a few minutes ago, that the balance really should be $16,700, we're going to have to make an adjustment. Now, I promised you that we would not get involved with debits and credits too much, so I'm going to just do it this way. What you're basically going to do is you're going to record bad debt expense in the current period, and that bad debt expense is going to be the difference between what your account balance is now and what you would like it to become. That is just the nature of an adjusting journal entry. An adjusting journal entry makes an account go from where it is to where it needs to be. So we record some bad debt expense. We also increase the allowance for uncollectible accounts by the same amount. And what will happen after this accounting entry has been recorded is that the allowance will increase from $10,000 to $16,700. It's an increase of a negative asset, so it's a bigger negative. And the source for that increase is recording an expense on the current income statement. So what you can see here is that when a company increases its allowance for uncollectible accounts, what really happens is net income will be lower in that particular period because expenses go up and assets, net assets, go down. Now, it's not cash that's going down, but it still is an asset that's decreasing. What you can also see is that we are trying to uphold the matching principle. What we're trying to do is say, why don't we record this bad debt expense on the same income statement where the related revenue is also recorded? So we've got the principle of conservatism and the matching principle being upheld here. Now, we've been creating this allowance. Guess what happens? Sometimes you actually have to use the allowance. What if we give up hope on one of our customers, okay? We've got this receivable, this $5,000 receivable, and not only is it over 90 days old, it's really old. And we've tried everything possible, short of threatening to put concrete shoes on this person and dump them in the river. It's just not going to happen. We're not going to collect this receivable. So we cut our losses and we write it off. Let's see what's going to happen. What's going to happen is this. The accounts receivable is going to decrease by $5,000, and we're going to use the allowance to accomplish that. That's the reason we made the allowance. Now, when we write off that account receivable, nothing is going to impact the income statement. This is purely a balance sheet transaction. The gross accounts receivable will go down and we'll use some of the allowance. The reason there's no income statement impact is because the income statement was affected back in the day when we created bad debt expense. The bad debt expense that created this allowance, that's when the income statement was affected. Now that we've given up hope on this customer, what you can see is the accounts receivable did decrease from $200,000 to $195,000, But then the allowance for doubtful accounts also decreased from 16.7 to 11.7. Now, interestingly enough, or at least as interesting as accounting can get, the net realizable value of our accounts receivable did not change. See, and the reason is we still think we have the same likelihood of collecting all those other receivables. Okay, that hasn't changed. We just gave up on this one bad egg. So the net realizable value, the total assets of the company, don't change. So using the accounts receivable balance is one of the possible methods for coming up with this estimate. Whether you look at the total receivable balance or whether you disaggregate it and use the aging method, coming up with an allowance based upon the balance sheet amounts, that's a balance sheet approach, okay? But there's another method that we could talk about. And that method is the percentage of credit sales. This is an income statement method. Has a more of a focus on the income statement. And the reason is we're going to use an income statement element, particularly credit sales revenue, to come up with this estimate. Now, sales revenue, we have divided here credit and cash sales. And the reason I do that, the cash sales, there is no risk of not getting paid. You already received the cash. So there's no need to make an estimate for uncollectible cash sales. So what we only do is focus on what's the chance that we would not collect sales where we have extended credit to our customers, where there's a risk of not getting paid. The income statement method basically takes that net credit sales and multiplies it by an estimate. Maybe our estimate here is, let's say, 1% of credit sales, which gives us $10,000. Now, the difference when we're recording this adjustment, here's the difference between the income statement method and the balance sheet approach. Under the balance sheet approach, we figured out how much extra allowance we needed in the balance sheet, and that extra allowance is what dictated the amount of bad debt expense on the income statement. Difference. First, we're figuring out the bad debt expense, and then we will adjust the allowance accordingly. So just like we did earlier, the bad debt expense on the income statement, it's going to increase by $10,000. And the allowance for uncollectible accounts on the balance sheet is going to get bigger by an extra $10,000, bigger negative, okay? But we're determining the bad debt expense first and the allowance second. It's an income statement approach. After we make this adjustment, here's what things will look like. The allowance will be a bigger negative because our net assets did decrease. Expense goes up, assets go down, and the net realizable value of the accounts receivable is 180 grand. Just as a reminder, when we put this at 180 grand, what we are basically saying to the readers of the financial statements, this is our best estimate regarding the amount of cash that we expect to collect from our customers within the next year.